Welcome to our deep dive into the world of inheritance tax. This tutorial is here to help you understand what inheritance tax is, how it works, and provide practical examples to ensure you're well-equipped to handle it. We'll break down complex concepts with visuals, data, and easy-to-follow explanations. Inheritance tax is a tax on the estate, such as property, money, and possessions, of someone who's passed away. It's crucial to understand as it can often lead to significant financial impacts for beneficiaries if not properly planned for. First, let's explore the threshold limits. In many jurisdictions, there's a tax-free allowance known as the nil rate band. In the UK, for example, this is £325,000. Anything above this value might be subject to inheritance tax at a standard rate. For example, if John's estate is worth £500,000, the taxable amount would be £175,000, £500,000 to £325,000. With a standard inheritance tax rate of 40%, the tax due would be £70,000. Inheritance tax rates and exemptions can vary widely depending on the country's legal framework. In the United States, only estates worth more than $11.7 million as of 2021 are taxable. Above this exemption, estate tax rates range from 18% to 40%. One common strategy to reduce inheritance tax is gifting assets before one's death. In the UK, gifts given more than 7 years before death are typically exempt from inheritance tax. For instance, if Kim gifts £200,000 to her children 8 years before she dies, it wouldn't count towards her estate for inheritance tax purposes. However, if she gifts it within 3 years of her death, it would be fully liable for tax. Now, let's examine some data. Here's a bar graph displaying inheritance tax revenue collected by the UK government over the past 10 years. As we can see, there has been a steady increase in inheritance tax revenue, reflecting rising property values and legislative changes over time. Another key concept is the spousal exemption. In many countries, any assets left to a spouse or civil partner are exempt from inheritance tax, irrespective of the amount. For example, if Emma leaves her entire estate, worth £1 million to her husband, there would be no inheritance tax due immediately. However, when the survivor dies, if the estate exceeds the tax-free threshold, inheritance tax will then be applicable. Let's move on to answering some frequently asked questions. What happens if inheritance tax isn't paid? If inheritance tax isn't paid, the estate can't be legally distributed to the beneficiaries until the debt is settled. Are there any ways to legally mitigate inheritance tax? Yes. Besides gifting, setting up trusts and utilizing life insurance policies are common strategies to mitigate inheritance tax. How soon after death must inheritance tax be paid? Inheritance tax usually needs to be paid within 6 months of the date of death. After this period, interest might be charged on the overdue tax. Before wrapping up, let's look at some historical data. Here's a line chart showing the inheritance tax thresholds in the UK over the past 25 years. As illustrated, there have been significant changes over the years, emphasizing the importance of keeping up to date with current regulations. In conclusion, inheritance tax can have a profound impact on the estate left to your loved ones. By understanding the key concepts, exemptions, and strategies to mitigate this tax, you can better plan for the future. Thank you for watching this comprehensive guide on inheritance tax. If you found this video helpful, make sure to like, subscribe, and click the bell icon for notifications on future videos.